Hi, welcome to the Crypto Republic. Before we dive in, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. This is where we break down the insider moves, the market mechanics, and the truth about XRP that nobody else is telling you. Stay informed, stay early. Holy smokes, folks, buckle up, because what I'm about to break down will completely rewire how you think about XRP, the banking system, and your financial future. You think banks are setting up cozy little vaults for you and your XRP? You think Fidelity, Schwab, or JP Morgan are working overtime to build retail custody solutions for investors just like you? Think again. Behind closed doors, these conversations are about protecting your XRP. They're about how to weaponize your XRP for their own balance sheets, their own cross-border liquidity pools, and their next generation of financial rails. And make no mistake, ladies and gentlemen, what happens in the coming months will separate the early movers from the crowd waiting for permission from Wall Street losers. Spoiler, banks don't hand out any golden tickets. This is not about financial advice. This is financial education, my friends. Let's be brutally honest. Banks move like dinosaurs. They don't pivot fast. They pivot with committees, lawyers, regulators, and government oversight. This is why when insider Jake Claver said he spoke directly with Fidelity, Schwab, JP Morgan, and Bank of America, none of them are ready to custody XRP for retail. He wasn't exaggerating. They don't have segregated custodial accounts. They don't have FDIC-style predictions for crypto yet. They don't even have the bankruptcy remote FBO accounts that you need to safeguard client assets. But here's the kicker. Independent firms are eating their lunch already. Digital Wealth Partners is already offering insured custody up to $100 million through Lloyd's of London. BitGo has been providing insured crypto custody since 2018 and manage billions of dollars in assets. Switzerland's SEBA Bank offers fully regulated institutional-grade custody already. Meanwhile, America's largest banks, well, they're still studying crypto. This lag is exactly why nimble players capture such early advantage. Just like fintech startups beat legacy banks to mobile payments. Retail versus institutional reality. This is an amazing thing we got to touch on. Here's the harsh truth. Banks aren't building custody for you. Why? Because you, the retail investor, don't move the needle at all. At most, maybe 2 billion XRP sit in retail wallets, about 2% of total supply. The other 98% is locked in Ripple's escrow account tied up with institutions, lost forever or earmarked for cross-border corridors. That's why when BNY Mellon, America's oldest bank with $47 trillion in assets under custody, announced it would be custodian for Ripple's stablecoin RLUSD. They didn't issue a press release about retail investors. They focused on infrastructure-level custody, the kind that underpins stablecoins, tokenized treasuries, and interbank payments. In Asia, South Korean banks like Worai and Shihan already announced XRP custody solutions. In Japan, 80% of banks are preparing to integrate RippleNet for payments, according to SBI Holdings. This isn't retail hype. This is the global plumbing of finance quietly being rewired. Let's take a history, content, finance, moves and waves approach with this, okay? Stay with me. Let's zoom out with some history. In the 1800s, railroad boom, small investors who saw the opportunity early became extremely wealthy. Institutions only piled in when regulation and monopolies took over. But in the 1990s internet revolution, it was the retail visionaries who bought Amazon and Cisco and Microsoft stock in the garage era, which saw thousand-fold returns, while Wall Street called the internet a fad. Even in Bitcoin's history, early retail adopters mined BTC on laptops while banks dismissed it as a scam. Today, BlackRock and Fidelity are quietly building billion-dollar Bitcoin ETF products. The same cycle is repeating with XRP. Banks are slowly moving ships, but nimble innovators. Retail investors, specialized custody firms, are capturing advantage in the early innings. Now, I want to go over the market cap myths and multipliers, okay? Let's destroy the most common FUD argument. XRP can't go past $5 or $7 because of market cap. This thinking is dead wrong. Here's the reality. Markets don't move linearly. Liquidity multipliers make inflows exponentially more powerful. This is a case study. During Jerome Powell's recent speech, just 30 million in inflow into XRP triggered a 15 billion increase in market cap. That's a 480x multiplier. Why? Because crypto liquidity pools are thin. A small inflow can push order books up across exchanges, creating outside impact. Now imagine an ETF. Analysts like Mark of Canary Capital project $5 billion inflow in the first 30 days of an XRP ETF. Otherwise suggests 10 billion. Even if the multiplier shrinks from 480x to just 20x, you're still looking at hundreds of billions in market cap expansion. That is why old school analysts capping XRP at $7 or $10 missed the point. They're using Bitcoin's trajectory, a completely different asset with no settlement utility. But XRP's suppression history is one of true legend. XRP is the only major asset class that's missed its true bull cycle. While Ethereum hit 4,800 and Solana touched 250 in 2021, XRP was locked in an SEC lawsuit. That legal weight choked speculation. That lawsuit froze U.S. exchanges listings, shutting down ETF filings, and scared off institutional capital. Now that cloud is gone. In July 2023, Judge Annalise Torres ruled XRP is not a security on secondary markets. That was a landmark decision that Ripple called a watershed moment. What that's meaning, for the first time ever, XRP enters a bull cycle without legal chains holding it back. This is XRP's first free cycle, where speculation and utility adoption collide head-on. Ripple projects by 2030, 10% of all global assets are going to be tokenized. That's 16 trillion in value. Bonds, equities, real estate, commodities are all moving on to ledgers. Now ask, who will custody these trillions? Will it be Coinbase, Binance, Kraken? Not a chance. Regulators won't let unregulated exchanges be the vaults for the world's financial system. That leaves only banks. And banks don't get to say no. Tokenization will force their hand. This is already happening. In 2021, JP Morgan launched Onyx, its blockchain unit, to tokenize short-term debt and treasuries. In 2022, HSBC and Wells Fargo piloted tokenized FX settlement. In 2023, BNY Mellon joined Ripple as custodian for RLUSD. Banks might stall on retail custody, but for institutional custody, the train has already left the station. And XRP, it's the liquidity layer built for high-speed settlement, not Bitcoin, not Ethereum. Let's take a look at geopolitics and the BRICS factor here. This isn't just finance, this is geopolitics. When Russia was cut off from SWIFT in 2022, it sent shockwaves worldwide. Suddenly, nations realized that U.S. could weaponize global payments. That's why BRICS, Brazil, Russia, India, China, South Africa accelerated their push for alternative rails. They're openly exploring commodity-backed digital currencies and Ripple corridors. But meanwhile, India's central bank has piloted wholesale CBDC settlements using blockchain. China's digital yuan already processed 250 billion in transactions. 80% of Japanese banks are already integrating RippleNet now. South Korea's Shihan Bank is testing XRP-based remittance to Japan. Asia doesn't wait for Washington gridlock. They act, and by the time the U.S. approves an XRP ETF, Asia may already be running full corridors. So if you want to take a look at the ETFs, loops, retail, shrinking roles, feedbacks, let's talk about ETFs for a second. When an XRP ETF launches, the demand won't just be retail hype. It'll come from funds, pensions, family offices, and wealth managers who cannot touch unregulated exchanges, but can buy ETF shares with a click. And an ETF requires XRP real reserves to be backed every share of access. Custodians must lock up XRP, reducing supply. That creates a feedback loop. Demand for ETF shares increase. Custodians buy XRP to back those shares. Supply will shrink. Prices are going to rise. Rising prices attract more inflows. More inflows require more XRP reserve. It's the same loop we saw with Bitcoin ETFs in the early 2024, when BlackRock and Fidelity ETFs pulled billions in inflows within weeks. Now apply that to XRP, an asset with real utility corridors behind it, and you'll see why retail's edge is vanishing. So let's take a look at this big picture. So let's zoom out. Custody isn't the starting gun, it's the finish line. By the time your Chase app says XRP custody available, the wealth transfer will already be in motion. Prices will be higher, multipliers smaller, demand institutional. Right now, retail still has a sliver of time, a shrinking window, before XRP is infrastructure, not speculation. The question is, will you wait for banks to validate XRP, or will you understand that by the time they offer custody, you're too late? Because history is clear. Early movers capture the upside. Late movers pay the premium. And with XRP, the repricing shock isn't hype, it's math, it's history, it's already in motion. If this opened your eyes, smash that like button, leave a comment with your thoughts, and most importantly, subscribe to the Crypto Republic. This is the only channel bringing you the truth about XRP, global banking moves, and the wealth transfer already unfolding. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic.